Raising funding for your startup is a challenge. How much should you raise? Where do you find investors? And how do you pitch them? In this segment, How to Raise Funding for Your Startup, we'll answer those questions and more. Here are live outtakes with startup founders on how to raise funding. I hope you enjoy this episode. Ever wondered how startups turn dreams into dollars? Today, we unravel the mystery of a startup that not only survived the tech world, but is now on the brink of a funding breakthrough. We're not just talking success stories, we're dissecting the strategic maneuvers that propelled the company to generate close to $200K in revenue. How did they manage to oversubscribe their current round? Who's eyeing them for the next funding fiesta? And most importantly, how can they turn this momentum into a multi-million-dollar investment jackpot? But it's not all about high-level strategy. We're peeling back the layers to reveal the intricacies of investor relations, the strategic dance of fundraising rounds, and the power moves behind deadline campaigns. Let's listen in. Hey there. Yeah. Thanks for taking time. Looking forward to catching up.
Yeah, same. How are you doing?
Doing good. Doing good. We're
How's the day
getting
so far?
cooler weather here in Austin. Where are you based?
I'm in LA,
Okay.
so always pretty good.
That's a great place to be. It's lots going on there for sure.
Austin's a nice place though. I hear always great things.
Yeah. It's coming up and doing well. So having a lot of fun with it. And
Yeah,
yeah, looking forward to catching up on what you're doing there at your company. How'd you get into it?
honestly, it just happened. It was one of those things. I played soccer my whole life growing up, and I was pretty darn good at it. But I always struggled to get seen without footage. I played overseas, and you're just always carving, honestly, like your path. And as a young player, to be able to like take the time off to do that is pretty cumbersome. So I spent about a decade in tech, building products for others. I ran an agency here where we built, either products for startups from idea stage to go to market to just about everything you can imagine, and also existing companies or even institutions, educational institutions. And then I just stumbled on a college athlete who was asking a friend to go record his next game because a 4-year school coach was asking for footage, and it just was deja vu, and I couldn't believe that it was still happening. I still didn't want to get in. I did about a year of market research and try to understand the lay of the land and understand why it's not happening. And then ultimately I got sucked in and here I am. So I love it. It's just like, I was actually, I just walked my wife and my daughter outside earlier today. They came to visit and I was walking back and thinking to myself, like, I'm just so lucky to be doing what I'm doing. Honestly, like being kind of embedded in the lives of kids and trying to help them, fulfill their dreams. I really call Replayer a dream making machine. And then being in tech, where I really like to be in, solving challenges and problems. It's great. So yeah, that's my short little backstory and my passion for it.
Great. So where are you with the company today? Are you generating revenue or still building product or what's the status?
Both, we generated close to about 200K in revenue, and we built product at the expense of sales. I'd say if you really take a deep dive into this emerging market, you'd really understand the shortcomings of existing products. And it's really because when you look at our competitors, they kind of took the hardware, hardware is hard, as they all say, and threw it to the back, and it was like an afterthought. And then they're all suffering from that. So seeing that as a founder, as someone that's call me a fast follower or whatever you please, I really wanted to address that head on. So we took about 3 years to get it right. And I think we're bearing the fruits of that with this MLS partnership being that recognition that I think we needed at that highest level. And then Fitness Industry Association, over about 100 sports enthusiasts voted us as the challenge winner this year. So I think we're turning the corner and people are realizing that we did solve the hard challenges. So we have about $48 million in annual recurring revenue in our backlog. So we have a pretty thick size, decent size wait list, and we're launching our production unit in December. We went through a beta phase last year, which was a public beta phase, paid customers, real cameras, and so this is going to be our bread and butter now, the real product entering the market.
So what are you raising right now? What's the current raise and how far are you into it?
875 is what we're raising. Quite frankly, we're way oversubscribed and we're almost done with the round. And this is really a bridge round. What we really need to raise is about like 4 to 6 million in the next round. So this bridge round was more like a strategic path towards getting to that, and I was advised by folks around me to go about it this way. So I'm thankful for their advice. But yeah, that's the current state.
What valuation did you put on the 875 or valuation cap?
10 mil.
10
So
mil?
far we've raised that 10 mil, 20% discount. And then I received another good advice. And I know that you're a veteran in this game. So if you hear anything and you have any input, please share your opinion with me. But because we're oversubscribed, we might end up raising a little more than 875 in this round. And then I think we'll go as high as like 1.2. And then anything more than that, we'll probably remove the cap and just stick with the discount.
Right. So yeah, what I would do is take the 4 million and break that into maybe three pieces, a million, a 2 million, and a 2 million. And on the first million, I would probably take a lot of these oversubscriptions and close out the 875 and move the other ones onto the $4 million round. Now we start with a convertible note, but it's going to be at $10 million. And it's a good price. And then you make clear we're raising 4 million and the average valuation is going to be 15. And so what you're doing is you're moving people into that next round. So we start to get traction on that round. So take the excess from this one and move to the next one. It's still money in the bank. It doesn't change it. But now we start to get traction on that first tranche. And if we can get 500 of the million done at 10 million, this is great. You know, we got a lot of momentum going. We can probably finish out the 1 million. And then you can say on my $4 million round, we've had our first closing. That's always a great signal to say I raised open a round and boom, everybody's showing up. You want to put like a 15 on the second tranche and a 20 on the third tranche. And you go out to everybody saying, when this money is done for tranche one, we're going to tranche two. And you start to create some scarcity for that money up front. And you start to use some of that current momentum you have into the next round to really get it rolling fast. Everybody's in this deal. It's picking up fast. We close the first tranche in 45 days. That's a great metric to take around when you start closing the next tranche, which is now at 15 million. This is going to start to give some people pause because the valuation went up. But the idea is you want to ladder the structure so that the sooner they come in, the lower the price. And that's a great thing to have people come in. If you make the same valuation all the way across 4 million, well, guess what? Everybody wants to be the last one in the deal, but we just can't all be the last one in the deal. Somebody's got to go first, and you have to give them a reason to go in first. And I like having that momentum you have there and just pushing it into the formal $4 million raise because we finished the 875. That's done. And everybody that wants to be in, you have to come in on this other one. But, you know, the valuation is still kind of low compared to the other ones that we're going to be doing. And so you start to see people really running in fast because they know the price is going to go up when they run out of that low cost shares. So that's one thing to think about. And you start with convertible notes until you find the right lead investor, and then they price the round, and then you can maybe restructure the rest of it to fit that new price, whatever it turns out to be. If there's really a bidding war, it's going to be higher. If it's not a bidding war, it may be lower a little bit. But the idea is you want to give people a structure. The other reason we do this is we like to run deadline campaigns. If I'm raising $1 million and I got 500, I'd go out to everybody and say, okay, in 6 weeks we're closing. We only have 500 left, and we like to track what we call interest and committed. There's 800K of interested on this deal, but there's only 500 left, so it's first come, first serve. And this is what really moves investors, is to know that other investors are in the deal. If you don't put out the interest and committed, you don't do a deadline campaign, they don't know. And so they don't know now's the time to get in, or I need to hurry up and do my diligence because I may miss the window here. So those are the kind of things we do, is break it down into rounds and then run deadline campaigns so we can take a group of people and make a decision, yes or no, you're in or out. And if you're out, that's fine. I don't have to worry about you anymore. If you're in, okay, let's sign the documents and move forward. Now let's go get the next group of investors coming in. So this is the kind of structure that takes a big raise and makes it simpler to do. Now, if somebody comes in and says, I'm a VC, I want all 4 million, you can negotiate that. The only problem is you only have one investor, basically what is the valuation they're offering? Can we agree on that? And that can be a tough discussion. If there are multiple investors, then you can maybe own the valuation a little bit more in that case. So those are my initial thoughts on it.
I love it. Yeah, that's great. I mean, you're seasoned in that space, so it makes sense. Quick question. So I have a couple of big check writers that are interested in participating. Big check as in for this round, big check. And they seem to kind of like drag in their feet, but they're very interested. How do you go about it in that sense? I mean, I've given them deadlines, soft deadlines, but I'm new to this, so I'm not liking or enjoying that they're dragging their feet as well.
Well, that's the value of having that $1 million round up front. As you say today or next week, we've closed our 875. It's done. It's over. We're now raised to 4 million. Here's the first million, and then a week later, you go and say 500 of it's gone. And when they start to see that other people are coming in the deal and the price is going up, that's going to signal to them that this is actually moving forward. And if I don't get in, it's going to come up. So you want to put out that ladder structure. You're doing 4 and so forth. You can do that. Now, if they're seasoned investors and they know what they're doing, then they probably have the ability to do their own diligence. And I guess you've given them a diligence box or data room. Is that true?
Yeah. Put together like a 20-some page memo through this Keiretsu chapter based on like all the questions that I've received so far from investors. So that's what I've been raising with.
Are these angels or VCs or family offices? What kind of investor are these guys?
So far they've been all angels, and then these ones that are following through. One is a strategic, and then another business.
Okay.
And then the other 2 are funds.
So, well, the thing with angels is I find they don't often have a rigorous diligence process. They know they're supposed to do it, but they really don't know what that is. And the strategy we use for that is what I call the due diligence walkthrough. You send in the diligence box, the report or the exec summary of it is what they need. And then you have a box with all the other documents, entity filings, patent filings, income statement, balance sheet, 5-year forecast, cap table, the basic documents are in there. And you send it to them and say, I want to show you where everything is in the box. And in some cases, there's only 12 documents, but we're going to show them anyway. And the purpose of this is to walk through and show them the entity filings. As you can see, we're a Delaware C. Show them the patent filings. As you can see, we have 3 patents filed, and we have 2 office actions, and we have 1 awarded, whatever. And along the way, they're going to ask you questions, and you're going to answer those questions right there on the spot. And they've got 3 to 5, 7 questions that they really want answered. And the reason they're dragging their feet is they know they need to get that done, but nobody ever took time to write out that and send it back to you. So what we're doing is we're surfacing those questions and we're answering it. When we get to the end of the diligence box, you've gone through everything. As you can see on the balance sheet, we have no debt. You see on the income statement, we have this revenue stream and these expenses and so forth. At the end, you say, do you have any other questions? And most often, you've answered them all. Okay, well, I guess we've done our diligence here. And here are the wiring instructions. And basically, they can mentally check off they've done their diligence. Question, can you pick up the phone and call them?
Yes, and I have, and one of them, these other guys, I should.
Can you today? Can I just pick up the phone and call you, and they'll say, oh, that's a replayer. I need to talk to him. Or they're going to say, who's this? Where are we with these guys?
The strategic, I should call them. You're right. I've called the angels and I've gotten a couple of them to move, but the strategic I haven't yet. So good point.
Well, the thing we're getting to is you have to have a little bit of a relationship. And the acid test there is if you can call them and they'll pick up and answer it and talk to you, you have a relationship. If you don't feel like you can call them because you might disturb them, whatever, well, you don't have a relationship yet.
Right.
And you have to have enough calls and touches with them, updates about what's going on in the business and so forth, to build a relationship where they feel comfortable talking to you on the phone. Email is great to communicate stuff out, but you really don't build a relationship with email, and you really don't get the feedback, like the questions that were trying to get answered. That just never came back because nobody ever sat down to write it out. you're on the phone with them, you get those questions as well, which you can answer. And so that's why we need to move. You send an email saying, let's talk. You don't hear it, you call them on the phone anyway. Just want to give you a quick update. We just got a big deal with Nike about to close. It's worth $5 million over the next 3 years, something like that. One rule of thumb is for every time you talk to an investor, have one new piece of information about the customer. Don't care if it's big or small, whatever, but you're always talking about what customers are doing, saying, thinking, and how we're interacting with them. It's always in the mix because that's the first thing they want to hear about is customers, how the product is doing and how the team is hiring and how the investors do. That's interesting too, but the customers are number one, so it's always in there. And you do 3 or 4 of those, you start to build a relationship, and now we can really start to seriously ask for checks because they know us, we know them, and it's just the due diligence walkthrough, and we're done.
Great. So I don't know much about your process, what you do there. Can you kind of unpack that for me? It's clear that you raised capital. You don't, I think.
Sure.
Invest,
So
right?
at Heart, we're doing investor relations and introductions. We're helping you find more investors. You sound like you have a lot. So what we would do in this case is help you close investors. So we often get brought in because I've got 10 guys and we want to close and then go raise more money. And we do that. And we do in-person meetings, in-person dinner events. One technique is if you had 10 guys in a city or area, we say we're going to have dinner at the Fogo de Chão and everybody come out and we're going to spend 2.5, 3 hours going through the deck and the pitch in a private dining room and answer everybody's questions and dig into it deep and so forth. And get a 30, 35% close rate. After that, you have all the information. You see, we'll keep you updated where we are on the track. But as you can see, this is going to get more expensive as you go along. And then sometimes they just say, well, I'm just out for other reasons and so forth. But we basically charge $3,000 a month for a 3-month commitment. And then we are running these investor relation campaigns where we're doing the updates, and in many cases, we're putting more investors on the list that want to see this and put you in touch with them. And then we're going out and we have angel groups we go to, if that makes sense. And we also have VC funds and syndicate funds we go to. And then we do the closings, which are basically in-person meeting and events and due diligence walkthroughs like this, where we're going out and working with them. We start with an introduction to our network. So we build a list of initially interested people, 50, 60 usually come out of that. And then we're inviting to hear you pitch in our online events. We do 5 a month. Then after that, we do these other things like the angel groups and the funds that we just work our way through the process. We're not a broker. There's no other fee. It's just that $3,000 a month. If there's a dinner involved, then we have to pay for the dinner as well. But it can be a very nice place or a nice, a not so expensive place as well. But those are the kind of things we do.
How big is your team? It sounds like this is a pretty serious operation.
There's 7 of us in the company right now. We're based out of Austin, so most of us are here in Texas, although we have some people outside of the state that are working with us as well. But at Heart, we're in the Austin region, and we work around the country and been doing so since 2016. Yeah.
What compelled you to reach out to me and Replayer?
Well, you went through Keiretsu, and we find that our successful clients are often coming from Keiretsu. A third of our deals come from Keiretsu. About 20% of our deals that didn't go to Keiretsu are going back the other way. And so we're to Keiretsu. And so we just feel like it's a good fit between the 2 programs.
And then what about if you can share any stats or numbers about success rates? I know it's pretty broad, but however you see fit, I'd like to hear something from you.
So there's 2 ways to look at it. One is we have what's called the campaign score. When you come in, we give you points for sending out mailers, updates, going to events, talking to investors, following up investors. And when you get to 100 on the campaign score, 90% have raised funding. Almost everybody's got funding by then. It takes 3-4 months to get there, but if you work it hard, you can. We have some people come in and, after 3 months, they've got 12 on their campaign score. Well, I can tell you they don't have money. They did not raise money yet. You have to do a certain amount of activity to get to the funding raise. If you look at the overall program, I'd say 75% of the people going through our program raise funding. The 3 reasons they don't is 1, they have an out-of-market valuation. We just think we're worth $50 million and we're pre-revenue, and that doesn't work with investors, especially in this market. Two, they were not active in the campaign. They got a 12 on the campaign score. They went to 2 events and never called back any investors. So, no money there, but, the introductions were made. And 3, they had something, some issue in the deal that investors have looked at that said, you really have to fix that first. You're missing something that we need to have. And in some cases, it's revenue. And in other cases, it's a recurring revenue model. The business model is not as scalable as it could be. It needs to be fixed. And some people step out, do that, and come back and go on to raise money. So those are the 3 reasons people don't normally raise when they come through the program: inactivity, out of market valuation, or a fly in the ointment that's just a little bit sticky for them.
And then do you see any difference between like folks that are raising a seed versus let's say Series A in terms of success rates?
Well, I find with the Series A, they often are more experienced founders, so they are usually more aggressive on the follow-up. On the seed, I find people are very hesitant to call investors back, but eventually you have to pick up the phone and call and talk to them to get money. So we have to just be out there doing it. Those who are a little bit persistent do well at that level as well. So that, I think that's just with experience comes confidence that I've got a good deal, and I think you ought to hear about it. And they're a little bit more aggressive in following up the investors. With the seed, they're all the time thinking this is a bad time to talk to them, and they're not sure they want to bother them, and so they don't, and so the investor doesn't get moved forward because you have to make several touches to really get an investor across the finish line. And like I say, build a little bit of a relationship. If you're good at that, you'll do well with this for sure.
And then when you talk about this process, how much of the investors do you guys introduce to these startups versus the founder doing the work to find these startups through your network?
Well, typically founders are halfway through their raise when they come to us, so they have a good network already. I've had people have 5, 10, sometimes I had 20 to 30. I had one guy that had a list of 60 to 70. Don't know how much he had qualified that list. So it varies quite a bit as to what they bring to the table. And they come to us because they were looking for more investors. And we're happy to do that. I think the thing we often end up doing is helping them close existing investors. Because like you say, these guys can stall out, and we can do things that kind of moves them across the finish line as well. Again, these in-person meetings and events make a big difference. And you always have to remind people, you're just not going to email your way to $1 million raise. You're going to have to get out and talk to people and meet them face to face and get them on the phone and do that kind of work. And so we're helping them with that, because if I get 10 people in a room, that can be very effective, very time efficient too. Buy dinner for everybody and go through the whole process and get 30 of them closing. Yeah, that's pretty good stuff, because you don't know who to follow up. We have 10 guys, which ones are serious? Well, do a dinner event and you'll figure it. You come to that conclusion pretty quick, who's really serious and who's not at this point.
And so I'm assuming this is just a lot of coaching, right? Founders, or you guys actually roll up your sleeves and do some of that work? How does it work?
Well, we're helping put the dinners together, get them in the room and so forth. But when you get down to pitching and diligence, that usually has to come back to you. We can't answer the detailed questions. And at heart, they want to hear from the CEO because they're sizing up the CEO as well. So we're trying to get the introductions made. And so we're out there doing that aspect of it and getting them interested and making sure they understand it. And then trying to get them into the dinner room for closing. So that's the part we're doing.
You've mentioned dinner quite a lot. Is that like one of the main things you guys like to do, is put together a dinner? Because a lot of the folks that I speak to are from different regions, in fact, different parts of the world too. So across the pond. Can you talk to me about maybe founders that are in that situation?
It was, like I say, it can be efficient to go to a city where you have 5 to 10 investors and bring them all together for one. And, we can do a lunch, or we can do just a dinner meeting where we're around the table in the main room, so it's not expensive or anything. Or we do the breakfast here, the coffee there, lunch here, and go around and meet people in different parts of the city. We can help organize those. So they take different formats based on how many people you have, if they're spread out. We start with the ones where there's concentration. I suspect that would be LA. or Southern California. And then oftentimes that goes to the Bay Area, and then it goes to New York. There's always a good number of people in New York that we do. Some people come to Austin. Almost everybody has 5 investors in Austin on their list. So they come out and we do a lunch for them there. So it can vary based on what that looks like. Like I say, I think at some point you really have to go meet people to close big checks. If it's 100K or more, we have to really think about that. The world is getting a little bit tired of Zoom. I find it's not hard to get them to come out now because I get to meet people in person. That's refreshing from what I did all day. And 2, there's a little bit of the social networking thing going on, which can be a draw as well. And then if there's only 5 people, well, then maybe it's either a lunch or it's 4 meetings around town, something like that. So it can vary based on the city and where they're located and their schedule, that type of thing.
Keiretsu it seems like, especially that chapter, there are a lot of biotech companies, medtech companies in there. Do you guys also have a heavy load of that? Is there like a preference by your group of investors? Because I think we might have been the only, tech, hard tech or whatnot in that mix this time around. And that was kind of my experience with other Keiretsu chapters too. That was my 3rd chapter I raised from.
So yeah, we have some life science in our program just because they're raising so much money. They need help. But then we also have a fair number of tech in our program that are doing well. And then there's a small portion that are everything else, climate tech, consumer product goods, et cetera. So it's kind of like Keiretsu. It's a heavy weighting of life science and tech deals that are in there. And angels tend to be generalists. They do a little bit of both. And so that can be very helpful. Same with family offices. VCs are very specific and narrow. So we're often a little bit ahead of where they invest too.
I have 2 final questions, and this will really help me solidify my understanding of your operation. One is we're getting to sort of the tail end of wrapping up this round, and then that gives us about 12 months of runway, and we want to go into raising that next round potentially in the way that you've mentioned it. So when would be a good time from your perspective to engage with you guys?
Anytime works. If you need help closing on the current, we can be helpful on that. If you need help launching the next round, we can be helpful on that as well. So anytime works. If your campaign goes over the last 2 weeks of December, we just automatically add that onto the back of your campaign so you don't lose anything for that. That's 2 weeks that really nothing's happening. Every other week of the year, something's happening. So we automatically take care of that. So I have people starting now because they want to get well positioned for a big push in January. I have other people that are wrapping up, trying to get it done before mid-December. And those are mostly going to be, closing things that we're going to do. So we always start with where you're at and go forward, knowing that you may be wrapping up this one before you start the next one, or you're just starting the next one. Either way works for us. So just let us know what you need help with.
Is there a follow-up question on that? Is there an advantage for pushing for the end of the year for tax reasons, for especially?
No, it's just time reasons. If I can finish this round up, then in January I can start on the next one. If I can't finish this one up, well, then I'm going to be finishing it up in January, February, and March. And so you've lost a quarter of next year doing last year's stuff. And so if we can make it work this year, we can't. We'll try. And maybe not everybody comes across, but you get most of them across. Well, then that would be worth it, and so forth. I do think you have till the middle of December, and that's 2 months from now. So that everybody's in town next 2 months, and so wouldn't give that up for sure.
And my final question is, just so I have a clear understanding of this. So you mentioned that a lot of the founders that come in bring their own investors, but you also mentioned that you guys do introductions. So what percentage of this is like your intros versus the founders' existing contacts?
Well, typically a lot of the founders are talking to people they know and whatever. So they usually have more contacts and they've got deeper relationships already. The guys we're bringing in are going to be people you don't know, and they're going to be harder to close because we have to build a relationship. So there's that aspect of it. The beauty of family and friends and first connections is that they're all in your network, you're in your region in most cases. And so that you've gotten past the relationship building thing, we can just talk about the business with ours, but eventually you run out of those and you have to go outside your network. And that's where we live. So it is a little bit of a different game. It's going to be a little bit harder to close our guys, take a longer time to close them too, because we have to build the relationship. the more of your guys that are in, the easier it is to do the outside because you've got lots of validation. Others are in, lots of money's in, and so forth. And that's always a helpful thing.
Thanks all.
All right. Thanks. Have a good one.
As we wrap up today's episode, consider this. What strategic move or insight resonated with you the most, and how can you apply it to your own venture or investment strategy? Remember, the real value lies not just in listening, but in applying these lessons to your own journey. Until next time. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.